Well, the more common of the U.S. gold coins are the $20 St. Gaudens, which were made from 1907 to 1933. There were hundreds of thousands of these that were minted in the 20s that never got out of the banking system. And when the financial crisis hit in 1929 and then the Depression hit in the 30s, a lot of these bank bags went over to Europe. So the Saints have an inordinately high survival rate.
Welcome back to the Money Seed Podcast. Today, my guest is Dana Samuelson. Dana is the founder and president of American Gold Exchange, and he brings over 40 years of experience in the precious metals market. Dana, welcome to the show.
Thanks, Gabe. It's great to be here with you.
Dana, how did you get into gold?
Oh, I got in through the side door. I got out of college in 1980 with a German degree, and I was completely unhireable. At the time, interest rates were sky high, inflation was red hot, the economy was not doing well, and gold and silver had hit record high prices. And my brother happened to be in the coin business, the rare coin business, and he was working for a company in Houston that was handling large volumes of physical silver. So I was hired because I could be trusted to help the guy in the vault that was literally processing tons of physical silver every month. So if it was a restaurant, I started right at the kitchen sink, counting, shipping, and weighing. And I did that for a couple of years. And I got a lucky break. I got an opportunity to go work with Jim Blanchard in New Orleans at Blanchard and Company. Jim was the gentleman most responsible for the private re-legalization of gold ownership in 1974.
Wow.
Yeah, when we went off the gold pegged to the dollar in 1971, Jim knew that the dollar would lose purchasing power over time, and he went on a crusade to re-legalize private ownership of gold. And people asked him after he got it, well, where do we buy it? And he said, well, I'll sell it to you. So he started a coin company kind of by coincidence. And by 1980, he had the largest mail order coin company in the business. So I got to work for Jim for 10 years in the 80s and early 90s. And I got to spend I became a senior trader, and I got to spend a lot of his money with the industry, and colleagues that I met back then. We were all coming up are still my friends today. So it's been a long career in a golden corner, so to speak.
Yeah, that's incredible.
Yeah.
And tell us more about American Gold Exchange. What types of products and services do you offer?
So we're a national mail order physical precious metals business. We buy from the various mints, the U.S. Mint, the Royal Canadian Mint, the British Royal Mint, the Austrian Mint. There's distributors here in the U.S. and sell to the public. We have transparent online live pricing for the various modern bullion coins. I'm also a vintage U.S. gold and silver coin expert, when gold and silver coins were actually money back in up to the 30s for gold and up to 1964 in silver. So I'm also a coin nerd, as I like to say. I'm actually a past president of the Professional Numismatists Guild, which is the leading organization of rare coin dealers in the country. So we deal in both modern bullion coins and a lot of the vintage U.S. gold $10 and $20 coins, mostly from the 1850s, 1860s, all the way to the 1930s.
So Dana, when the average investor comes to you and says, hey, look, I've never owned gold before, I want to add it to my portfolio, what are the types of questions you ask them? And what are some of the biggest myths that the average investor has?
Well, we want to know what their profile is. You want to have more risk and reward. If you go into the vintage coin market, it's a supply and demand driven market as much as it is a gold market. So there are premiums that wax and wane. So there's more profit opportunity, but there's also a bit more risk in those items because they're leveraged to the gold price. But if you buy them in the wrong time in the cycle, you could be paying too much or see a market that weakens. Most investors these days want just gold for gold's sake. An ounce of gold at the lowest possible price that they can get it. And that's what we specialize in the modern bullion section, are just bread and butter, modern issue gold and silver coins made by the major mints and a couple of the biggest private refineries there are in Switzerland. So we'll ask a client, okay, what is your time frame? How long do you want to hold this for? Do you want to have more gold or more silver? These are the opportunities for each. Sometimes they're out of balance relative one to the other. We measure that by the gold to silver ratio, how many ounces of silver it takes to equal 1 ounce of gold for relative value between the two. When the ratio is about 65 to 1, that's in balance. When it's less than that, gold is cheaper relative to silver. When the ratio is higher than that, silver is cheaper relative to gold in the modern world. So we ask that. We also ask, how do you want to store it? You got to store it yourself. And then we walk through the various mint products, which has the better premium right now, because we have seen some supply strains over the last few years. There's been a lot of demand for physical gold since COVID erupted and the deficit spending blew up and the economy tanked. And then now we've got the Fed overstimulating and inflation and now higher interest rates and bank failures. This has all led to just an abnormally large demand for physical gold and silver over the last 3 years. Much like we saw during the great financial crisis. So some of the mints can produce well in this environment and some can't. And at that point in time, with the mints that don't have enough product, well, the premiums for what they do have can be higher than normal. So we'll walk people through what the best value for them is. And then there are some tax reporting requirements that we have as dealers when the public sells back to us, not when you buy, but when you sell back to us. So we talk through that with them to see which products might be a little bit more advantageous than others. Basically, we help people get a handle on what this is all about, what makes the most sense for them, and what their risk-reward ratio is, time frame for holding, and storage. Those are the main things. And insurance. How do you insure if you want to, have an insurance policy on your metals? But we are a physical dealership. We like to deliver the metal to you. We don't store it for people ourselves.
And typically, what do you recommend on what % of someone's portfolio should be in precious metals?
Well, any financial planner will tell you 5 to 10% of assets is a good percentage to have in precious metals. The World Gold Council did a study going back about 25 years that says the sweet spot's between 6 and 8%, because that gives you enough of a hedge in precious metals where it'll be meaningful if you really need them to do what they're supposed to do, like they did during the great financial crisis, without taking opportunity from other areas where you might invest, real estate, stocks and bonds, whatever. So 6 to 8% is really where the sweet spot is.
And Dana, I know there's many different ways to invest. Some people invest through an ETF. Some people like to put physical gold in a vault in Switzerland. And some people like to have gold in their own home or in a safety deposit box in the town where they live. What are some of the advantages or disadvantages to either one of those? And why did you become a physical gold dealer?
Well, I think that if the main point of owning gold is that you have it yourself. That's really why we do not store for people. We want to ship you your merchandise and we want you to hold it. It's your gold. The benefits of owning gold are basically, it's one of the only assets known to man that has no simultaneous counterparty risk, right? It's not contingent on a company to produce a return like a stock value is contingent upon that, or a country or a renter to pay a debt, a mortgage, right? So you don't have counterparty risk with real estate. You would have counterparty risk with real estate, which you don't have with precious metals. So we want you to have the physical precious metals. That's really the primary reason for owning gold. Now, if you have a large volume of silver, it takes up a lot more room. 100 ounces of gold is about 8 pounds. It's about the size of a paperback novel. It's $200,000 approximately. It's easy to store that value somewhere in your house or in a safe deposit box, which I don't recommend anymore, by the way, because it's the way that some of the banks are going with writing precious metals out of the charter. And you don't want to have your metal in a bank box if there's a bank holiday, right? So, but gold, the point is gold is very compact. If you have a lot of physical silver, you may need a place to store it. And in that case, we typically recommend a couple of storage facilities here in the US that are privately run, that have been in operation for a long time, that we trust ourselves to recommend. Now, an ETF is a great way to harness the price movement of gold and silver on paper at a very competitive buy-sell spread, because it's like owning a stock, but it's not like owning the real thing. I mean, what gold allows you to do is to take some of your money, your hard-earned wealth, and get it out of the banking system, number one. Get it out of the dollar, which is losing purchasing power. Right? One of your guests, Jason Cozens from Glint, has explained very well to your listeners how it's not so much that gold is going higher in price, it's that the purchasing power of the dollar is going lower and lower. And gold is really a constant. It just takes more and more dollars to buy that same ounce of gold, which is an excellent way for people to think about it. Because we think about it the other way around, and it's the price is going higher. No, everything else is buying less and less, which is why owning some gold is a good way to go. Now, you can store it in a vault in Switzerland if you like, but you really want to have access to it in case you really need it. It's true, portable, transferable wealth outside of the banking system and outside of the government's prying eyes.
And you talked about price movements. I noticed that the price movement on gold, especially over the last year or so, has been quite extreme. So back in November of 22, it was just above $1,600 an ounce. And then a few months later, in May of 23, it was almost at $2,100 an ounce, a roughly 25% move. What can drive gold to move that much in such a short period of time?
Well, gold tends to trade inversely relative to the value of the US dollar. So if the dollar is, because gold is priced in dollars, like oil has been priced in dollars. So if the dollar is more valuable relative to other currencies, and most of the gold in the world is bought outside of the US, which it is, physical demand in the US is among the smallest countries compared to Asia and Europe. When the dollar becomes more valuable, it's more expensive for people in other countries to buy gold. That tends to push the price of gold down because there's less demand for it. Another thing that affects the price of gold is our interest rates. You know, what the federal funds rate is, and more importantly, what treasury yields are on the 10-year treasury, the 2-year treasury, the 20, 30-year US treasuries. Because if you can get a yield that's reasonable, which gold doesn't offer a yield, there's competition for that same money and a safe haven. Now, last year in particular, we had a very unusual situation where the Fed started to react to inflation very aggressively. And they went into the most aggressive rate hike cycle in the shortest period of time that they've done in a generation. And the US economy was more stable than the economy of China and Japan, and especially in Europe because of the Ukrainian war, and inflation's ramping up. So what happened? A lot of money from around the world, Japan, Europe, Great Britain, came into the US for safe haven to get into our economy because our interest rates here were higher than they were in other places, and the money was safer here. Well, the gateway to do that is the dollar. So the dollar at one point in time last year was up about 15 to 18% against almost every other major currency, which is like a moonshot for the dollar. If currencies move 3 or 4% against each other in a year, that's a lot. And this was multiples of that. Well, that pressured gold down to cyclical lows late October, early November, when the dollar reached its peak. Now we look at the US dollar index, and it got to be about 114, which measures the dollar against a basket of other currencies last October, early November. It started the year at 95, and it went to 114, which is a gigantic moonshot. Now it's back to about 103. So that has helped to push gold to abnormal lows and helped gold to rebound back to the 1950 range. You know, we've been over 2000 on the back of the SVB bank failure and a panicked rush to buy. So, but we also have another variable, which are interest rates. And interest rates have helped to keep gold a bit in check. But with the crisis in the financial system, the debt explosion, the inflation run, gold's holding up pretty well in the face of the highest interest rates we've seen, in 20 years.
And it seems like because we have a fiat currency, if we continue to spend the way we're spending as a government, if we continue to rack up debt, is it fair to assume that over time gold will continue to go up relative to the US dollar?
Absolutely. I've never been more certain of this in my entire 43-year career than I am right now. Between 1795 and 1996, the US accumulated $5 trillion in debt. It took us 200 years to get to 5 trillion in debt. And in the last 28 years, our debt has multiplied sixfold to over 32 trillion now, right? And with these higher interest rates, now our debt interest on an annual basis has gone from 500 billion a year ago. It'll be close to $1 trillion this year because the interest rates are so high. Our debt is going to continue to go higher, not at $500 billion or $1 trillion a year, probably $1 or $2 trillion a year now going forward. And the interest to carry that, to service that debt, the payment is going to be close to $1 trillion a year, or maybe $1.5 trillion at these higher rates. And we're getting into a death spiral on the debt, where our GDP is 20 trillion a year. Mm-hmm. And we're going to have debt service. It could be 5% of that, 7% of that, just to service the debt, which is crazy. And this is all a recipe that's disastrous for the dollar. Disastrous over time. It's good for gold. Yeah.
And if people want to acquire gold, right? And let's say they do want to acquire physical gold and they want to keep it, they have many different options, right? They can get gold coins from Canada or Australia, South Africa, America. Maybe talk to us a little bit about the pros and cons of each.
Well, I'm in the US, so most of my clients want US gold and silver eagles, which the US Mint has been making since 1986. They're the most popular product here in the US. The second most popular are Canadian gold and silver maple leafs, which have been being minted, the gold maple leafs since 1979, silver maple leafs from mid-1990s. Third mint is now the Austrian Mint, which makes gold and silver philharmonics since 1999. Of course, going back to pre gold being available to buy in the U.S., Krugerrands were made in South Africa starting in 1967. They were the preferred gold vehicle back then, and bars were as well from refineries. So there's South African gold and silver Krugerrands. What we like to do is look at what's the most popular, what's going to have the best resale value, what's the best price today, because not every mint has been able to keep up with demand. So we've seen some premium changes over the last couple of years in a high demand environment. So we look at tax reporting as well. We have tax reporting on 1099B that we have to fill out when we buy from the public 25 ounces or more of gold or 1,000 ounces or more of silver in a single or related transaction. The IRS gave us a shopping list of which items were reportable back in 1986, and gold eagles were not on the shopping list back then because they hadn't started making them at that point in time, while Canadian gold maple leafs and South African Krugerrands were on the list. It was what was deliverable against a COMEX contract at that point in time. So there's some anomalies in the law that make gold not necessarily something you shouldn't pay taxes on, but something I don't have to report as a dealer. So we go through that as well. And then there are refineries that make gold bars as well. The PAMP Swiss refinery, the Credit Suisse refinery, Valcambi. But here's the rub with bars. We're having a modest but growing problem with Chinese counterfeits. Mm-hmm. And what they're doing is they're taking tungsten and they're plating it with gold because tungsten has a density that's close to gold. And it's much easier for the Chinese to replicate the image of a gold bar that is more plain looking and pass it off as a good, legitimate item. Where every mint around the world in the last few years has added more design elements into their sovereign minted 1 ounce gold and silver coins that'll make it harder for the Chinese to replicate that design. They've all done it to stop this problem. So I don't think that it's in people's best interest to buy bars, even though they might save a few dollars an ounce, because I think there will be a sellability problem with them in the future, not so much as getting paid for them, but the settlement time, instead of being instant, might be a couple weeks. You know.
And I imagine you handle gold all the time, so you probably have a good feel of how they sound and how they feel. But how often do you come across a counterfeit coin, for example, in your practice?
Oh, very rarely, but they're out there, and it's a problem it's just impossible to stop. They're coming in through online auction platforms and private sale platforms, getting shipped directly from from China to the public here in the US. People think they're getting a deal and they're not. But it's hundreds of thousands of dollars, but we do hundreds of millions of dollars worth of business. And as an industry, we do billions of dollars worth of business. So it's a small problem, but you don't want to be the one that, got a bad bar or a bad coin. The coins don't fool professionals like me. They don't, but they could fool the public pretty easily that don't know.
Yeah, and I imagine that's the whole point of going to a trusted dealer such as yourself, right? Is that, yeah.
Exactly. You want to do business with a long-standing member of the community. You want to do business with a dealer that has good reviews, that doesn't have complaints, that's been in business for a long time, and that has something besides, hey, we've got a great business on their website. Drill down. Now, I'm a member of the Professional Numismatists Guild. There's about 350 active members today. We're all over the country, and we're among the leaders in the industry because of longevity in the business and reliability.
And I got a question about selling. So let's say I buy a gold coin from a dealer such as yourself. What is the typical bid-ask spread, right? In other words, how much can I lose on the transaction or on the arbitrage per se?
Well, physical gold and silver have a bit of friction because there's a manufacturing charge that has to be perfect. The weight, purity all have to be exactly right. There's shipping, there's profit. So the buy-sell spread, same day, same gold spot price on an ounce of physical gold is about 4%, which is why these are not trading vehicles. This is something you want to buy and hold and put away. It's not something you want to buy today and have to sell next week. On silver, it works out to $1 to $2 an ounce, which relative to the silver price is 5 to 10%, 12% right now. But that's just the nature of the beast with the physical product. And we're very competitive. There are people you can buy from online that you'll have a wider buy-sell spread than that even. So there's friction on the transaction. That's what I'm trying to say.
And I'm glad you pointed that out. Yeah. So these are not meant for trading or frequent buying and selling. You buy it, you're holding it for a long time.
Right. Yeah. That's what we recommend.
And earlier you mentioned, Dana, that you also deal in antique coins, right? So coins that were, I guess, pre-1933, back when gold was legal. And there were a lot of American gold coins at the time. Over time, do you see those appreciating more or less than the strictly gold coins?
Well, because the available supply of them is limited to what was made years ago, and more importantly, what survives today, because there's been a huge attrition over the years through melting, mishandling, the available public to buy them, the pie keeps growing. Over time, the values tend to improve relative to the intrinsic metal content. Now, we've gone through an unusual period in the 20-teens where we had some dishoarding of U.S. gold coins that have been in vaults in Europe for decades. When the premiums got high following the great financial crisis here, because there was a lot of physical demand for gold, banks that have had these bags of U.S. gold coins that went over there in the 20s and 30s as trade payment came back here, mint quality coins, and the market kind of got flooded. So premiums for $20 gold pieces minted in the 1920s or in the early, turn of the century, 1900, 1904, got as low as we've ever seen them in 2018 and 2019. And we sold a ton of them to our clients at low premiums. Well, then COVID hit, demand exploded, and now the premium or the collector value over the intrinsic value widened way up. So I've got clients that have made 20% on their gold and another 20% on the coin, or 30% on the coin, if buying the right ones. But over time, there's less and less of them to go around. Mm-hmm. So they tend to be a good long-term hold, and sometimes better than an ounce of gold minted yesterday because of their scarcity. But you need a pro to help you guide you through that, which is what we do.
And again, you've been doing this for over 40 years, and it sounds like you are as knowledgeable as they come in this business. And if you were to recommend a specific mintage or coinage, I'm talking about like antique coins, old coins, for a starting investor, somebody who's just trying to get in, what's a good series to get, or what's a good thing to collect?
Well, the more common of the U.S. gold coins are the $20 St. Gaudens, which were made from 1907 to 1933. There were hundreds of thousands of these that were minted in the 20s that never got out of the banking system. And when the financial crisis hit in 1929 and then the Depression hit in the 30s, a lot of these bank bags went over to Europe. So the Saints have an inordinately high survival rate relative to almost every other vintage U.S. gold coin because they survive the ravages of time in mint condition. So you can buy these at a lower premium than most of the other coins. So if you want to get started, that's a great introductory coin. But if you want a better investment because of scarcity, I like the $20 Liberty series better, which came from 1850 to 1907. It's the design before the $20 Saint, because the survival rates for those are much, much scarcer. And when you can get one of those in a good quality rating at a low premium, the potential for that to have a higher rate of return is really good when demand hits, because there's just simply many, many less of those to go around. And we've seen that happen a couple times in the last 30 years.
Dana, as we move to wrap up this discussion, it sounds like you're extremely knowledgeable. Where can people reach you if they have any more questions or if they want to invest in gold themselves?
Well, our website is www.amergold.com. My head kind of blocks that off on the video. amergold.com. Our email address is info@amergold.com. And our telephone number is 800-613-9323. We have a consultative business. We're a small business. We do a big volume. And we'll help people, talk through, okay, what are you trying to do? Like I said earlier, risk reward, balance, holding, storage, insurance. We help people, no pressure, any order is a good order for us, small or large, but we tend to do a lot of larger trades with clients who get to know us and trust us over time.
And I believe you are located in Austin, Texas. Do you ship to all 50 states?
Yeah, we do ship nationally. We don't ship internationally. I don't want to be an import-export expert. Some states do have sales tax on precious metals. So, and we have that all listed on our website, and we can walk you through whether you're in a state that has a taxable sale or not. And they're all different. Many states don't. Some have a threshold level where under which it's a taxable trade, over which it's not, $1,000, $1,500. But we can help work you through that as well.
That sounds excellent. I'll put those links and notes in the show notes when the episode goes live. Dana Samuelson from American Gold Exchange, thank you very much for your time today.
Gabe, it's been a pleasure talking to you. Thank you for having me.
Hey, thanks for joining us for another episode of the Money Seat Podcast. Please remember to click like and subscribe. It really helps spread the message to other investors, and it helps attract new viewers to the show. We appreciate your support. Thanks very much.